Hello everyone. Good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier sessions related to the chapter of production, that is chapter 3, unit 1 of business economics, we discussed about the meaning of production and the factors of production, and very importantly, what are the characteristic features of different factors of production like land, labor, capital, and entrepreneurship, and also some of the additional aspects related to capital and entrepreneurship, particularly like the process of capital formation. And in the case of entrepreneurship, what are the challenges that normally organizations face and what kind of objectives the organizations strive for. These aspects have been discussed in the earlier sessions, which are general discussions and more broad in nature rather than very specific. Now entering into the technical aspects of this particular unit, that is theory of production. Within that, today let us discuss about the production function and also how the production function can be broadly classified into the short run and long run time periods. To particularly focus on the short run production function, we'll discuss these aspects in the current session. First of all, what is a production function? That is a statement of relationship between the inputs and output. Simply speaking, how the inputs are related to the output. In what combination of inputs, if the firm is using them, how the output is generated with that combination. If that is expressed mathematically, that's what we call as production function. So what it simply tells us is the relationship between input and output. Input, there are many, so inputs. Output, there is one, so that is output, that is singular. If a production function is algebraically expressed in the form of an equation or a mathematical equation, we can call this like that. Q, it can be expressed like Q is equal to a function of A, B, C, D, etc. till N. So what is A, what is B, what is C, what is D? All are inputs. One of them could be land, one of them could be labor, one of them could be capital, that two different kinds of capital, entrepreneurship, etc. There are many inputs which will be required to generate the output called Q. In other words, the output here is the dependent variable, and it is dependent on what? The inputs. And the inputs are called as independent variables. So the A, B, C, D, etc. are the independent variables, we can call them, which are inputs. Using all of them in certain combination, an output which is a dependent variable of Q is achieved. But what is the function? What is the relation between Q and A, B, C, D? That we are not able to tell with any derivation of production function. If we can do that, what we get is called as PhD. So, for any particular situation, if a production function can be actually mathematically derived, that is altogether a research project, which we are not going to do. But certainly what we are going to know is, yes, the output, that is Q, is dependent on many input factors, and there can be a possible expression of the relationship between the inputs and output, like Q is equal to a function of A, B, C, D, etc. That mathematical expression or algebraical expression is what is called as production function. Once again, we are not going to establish the relationship between Q and A, B, C, D. that is way beyond our level of understanding and requirement. But what we are going to know is that there is a relationship, that's all. What is the relationship, how they are related, what is the actual production function of a particular factory. Every factory will have its own production function, and we are not going to derive that function. We are only trying to understand that there are different factors which have an influence on the production or output. If they can be expressed as an algebraic equation, it would look like this. A function of, it is mentioned. Which function, what function, that we don't know. Some function, some relationship. What is that relationship? That we don't know. So that is the production function in a nutshell, which is just an expression of relationship between inputs and output. But there are certain assumptions in this production function theory. What are the assumptions? First of all, this relationship between the inputs and output exists for a specific period of time. In other words, when we say Q, the quantity, the production, that is not a stock concept, that is a flow concept, which means it is for a particular period of time. So production per year, production per day, production per month, like that it can be told. For a specific period of time, whatever it may be. But Q is not a measure of accumulated output over the time. It is not. So that is the first point. To sum it up in the words that we already know, Q, which is the expression of output or production, is a flow concept, not a stock concept like capital. So that is first point of assumption in this function. Second assumption is that there is a particular state of the art in the production technology. In other words, the state of technology is already given, means fixed. If that changes, the entire production function changes. So this for production function, if at all we come to derive it with a lot of difficulty and suddenly there is a technology change, that function itself will become invalid. So what does it mean? There is a given state of the art in the production technology. The state of the art is generally what is used in common parlance as the latest technology or the best technology possible. That's a phrase that is used like that. But particularly for understanding purposes, we can say the level or state of the production technology is given. When the word is used as given, means it is constant, it is fixed, it is not going to change. If at all there is any innovation, definitely that will change the relationship between inputs and outputs. For example, if robotics are used in the manufacturing or some efficient software packages are used for financial analysis, definitely the input-output relationship will be different. That will change the relationship. So the production function, whatever it may be, if it is valid, if it has to be valid, the state of the art of the production technology should be fixed. That is given. That is second assumption. So first assumption is that production is expressed for a period of time. Second assumption is that technology is constant. Simply speaking, technology is constant. Then the third assumption is that whatever the combination we are talking about in the production function, the output that is resulting from that function is at the maximum level. That means the best possible output we are talking about. The best possible output with the combination of different inputs being used at the same time is what production function is expressing. So that is the third assumption. Whatever the combination might be within the production function of the inputs, but ultimately the output what is resulting from their utilization is always going to be at the maximum level. It's an assumption once again, not reality. Same way technology also will not change. It's not a reality. But in order to have a valid production function, these three relationships or these three assumptions will have to be always made. That production is a flow concept, not a stock concept. Technology is constant. Output expressed in the production function is at the best level of output. That is the best possible outcome, we can say. That is maximum level. So that's what production function is all about. If the same thing is defined with certain big sentences, it will look like this. What is production function? That is the relationship between the maximum amount of output, maximum, that can be produced and the input required to make that output. So the relationship between the maximum output and the inputs which are required to make that output. That's what production function is. And of course, it is defined for a given state of technology. It is not going to be changing. The technology is assumed to be constant when one production function is derived. So simply speaking, the maximum amount of output that can be produced with the given quantities of inputs under a given state of technical knowledge is what is called as production function, or the output which is expressed as a relationship or a combination of various inputs. So that is the definition of production function, we can say, or the formula for production or equation for production, we can call it. Okay, it can also be defined in a different way. Like what? It is the minimum quantities of various inputs that are required to yield a given quantity of output. So here 2 points are there. Maximum output is generated by using certain combination of inputs, or same output is generated by using lesser quantities of inputs. So what is the bare minimum combination of inputs that are required to yield a particular quantity of output that is targeted? That is also the same. That can also be another way of expressing what a production function is. So that is the algebraic relationship, we can say, though actually speaking we did not establish any relationship. We are only observing that there is a possibility of such a relationship. That is production function. And what are the independent variables or the inputs we can call? Definitely inputs will be various factors of production, as we know already some of them: land, labor, capital, enterprise. All of them are inputs. Ultimately they will all be used in a perfect good combination, and they will result in the best possible output. So for example, let us say if a company is manufacturing beverages, something like Coca-Cola or Pepsi, what will be the inputs? They need plant and machinery, definitely yes. They need raw materials like water and carbon dioxide. Sweeteners they require, flavorings they require, and for doing all this work they require labor. Support staff will be required, supervisory personnel will be required, packing will be required, transportation will be required. So many things are required in order to perform the production of any product. In this example, let us say beverages. All of them put together, the inputs, all of them put together will result in an output. That is what production that is targeted by the enterprise. So if at all we would like to only restrict the relationship of production with only two factors of production, which are the major and most important factors of production, production function can be expressed even like this also. Q is equal to a function of labor and capital. Labor and capital. Again, how much labor, how much capital, that is not we are going to define. But what we are going to observe is, by having an effective mix of factors of production like labor and capital, we can get the best possible output called as Q. And if that relationship is expressed as an equation, then we can say Q is a function of L and K, where L is labor, K is capital. Sir, why I want to use K, I will use C. No problem, doesn't matter. Nobody worries about what is L, K, Q. What matters is the relationship, and what is dependent variable and what is independent variable, that we should be observing. So what is dependent variable in this case also? Naturally Q, that is output. And what are the independent variables? Labor and capital, which are going to influence the dependent variable of output. How they will influence? Once again, that is completely left to the reality. Cannot be defined just with some kind of imaginary things. Though some people try to define it, we will come to that later. So that is the production function. And here, why to take only labor and capital? Why can't we take all other factors of production? We can take. We are only taking a simplified version of production function, taking major factors like labor and capital. There will be so many other factors also. All of them put together, only production will happen, and production function definitely will need to have all the factors incorporated in it. But still, just to keep it simple and straightforward, we can express the production function in a very short form and a direct relationship, very good, strong relationship between the two factors and the output, that is labor and capital, which are the most important factors of production for actually performing the production process. That is the production function. Now let us look at how the production function will be there in the long run and short run. This is very important aspect to understand conceptually, otherwise once again these names can be misleading. We generally go by these names: long run, short run. What is long run? Months, years, or what? Short run means what? So we cannot define here short run, long run on the basis of certain period of time. That is not correct. When we talk about the economic analysis, now onwards, even for production function also, cost function also, the distinction between the short run and long run is not related to any particular measurement of time. No. These many days, so it is short term. If it crosses, it is long term. No. These many months, 12 months, less than 12 months short term, more than 12 months long term. No. All these definitions we can do at other places like accounting and other cases. No problem. But not in economics. Here, what is short run, what is long run? First point, you have to understand, it is not related to any particular measurement of time. That is a basic point we have to always keep in mind. And what actually this long run, short run refers to is where the firm can vary the amounts of inputs in the production process. There will be definitely a lot of inputs in the production process. We already know that. How a firm can vary certain amount of inputs in the production process? If it can vary all the inputs in the production process, then that is called long run. If it can not vary all the inputs in the production process, that is called short run. In other words, when can we call certain period as short run is when at least one of the inputs remains unchanged during that period. This is the most important definition for short run, and this is going to be useful not only now, even later also. So understand this concept very carefully, not giving our own interpretations and assumptions and thoughts and whims and fancies. Those will not help. Short run does not mean any time period here we are talking about. We are talking about that is the overall period in which at least one of the inputs remains unchanged. Means one input at least is constant. Which input is constant? Whatever input it could be. That we don't know, we don't need. But what we definitely should know is short-term period means that period where all the inputs cannot change at the same time, just impossible. Means what? If there are, let us say, 10 different inputs which are going to result in an output, 9 inputs can be changed, but if the 10th one cannot be changed, still it becomes a short run only. If all the 10 can be changed, then only it is a long run. So that is the reason, once again, to understand what is a short run period here, it is the period where at least one of the inputs remains constant, unchanged. That is what is short run. Okay. So that's what short run production function tells us. What is that? Maximum amount of good or service that can be produced by a set of inputs, assuming at least one of the inputs remains unchanged. That's what we can call it as short run production function. We will discuss that short run production function and production theory. But what is the underlying assumption in that? At least one of the inputs remains unchanged, that is constant. Okay, that is the point to be noted. So which input remains unchanged? We don't have to really get into that. But still, if we want to see which inputs are difficult to be changed at least in the short run, is particularly new capital equipment. In other words, the capital is something which is generally a fixed factor in the short run. If you want to install new machinery, build a new factory, it is not going to happen in a very short period of time. It will take a lot of time. So in the short run, the capital equipment addition to the existing facility is not going to happen. So that input, which is very important input, machinery, you can call it for simple purposes, machinery or capital, and that to which capital here we are talking, the fixed capital. So the fixed capital will be a fixed factor in the short run. So usually when we look at the short run production function, what we can understand or generally assume is the quantities of capital is fixed. And then we can vary the other factors, like for example labor or for example raw materials, like that other factors can be varied. In the short run also, suddenly you need more laborers. Possible, though not that easy, possible. You need 100 more people. There are people who can, there are organizations who can supply people also. So it is not that difficult, though it is not that easy also, to change vary the amounts of inputs like labor or raw material. But to change the inputs like machinery, equipment, which is represented by the capital, that is very difficult in the short run. So what we can say, which factor can be definitely considered as fixed in the short run is capital. That's it. And when we do this analysis of short run production function, how the short run production function is going to behave, keeping capital as a fixed factor and observing how the change in any one of the factors is influencing the production function, that is what we call as the law of variable proportions. That is the short run production theory, we can say. Very important, because that is the one of the two theories that we are going to study in production process. So definitely both short run and long run are important, but short run theory is relatively more important also, even from examination point of view. But what is the name of the theory? That is called the law of variable proportions. And what is that going to happen in this theory? We are going to observe how the production changes with the change in any one of the factors like labor, raw material, etc. But definitely assuming at least one factor is fixed, whichever factor that might be. But in general, we can consider that as capital being a fixed factor. That is short run production function, we can say. Sir, can we study the production function in the long run also? Yes, definitely. Then what is long run? Opposite. The long run is a period of time. Look at this word, this you have to remember, that is called planning horizon. Planning horizon means a very long run period. Once again, period does not mean you should immediately think about how many months, how many years. That just normal understanding of these words should not be applied here. What is long run? Yes, it is a period of time, but how many months, how many, we cannot quantify that period. But what is the characteristic of that period? The long run period, where all the factors of production are variable, in the sense changed. They can be increased, decreased, changed, whatever the firm wants to do, they can play with the factors of production, because any factor of production can be changed, none of them is constant. If any of the factors of production is constant, then it is a short run period. If all the factors of production are variable, which are possible to be changed, then that time period is called as long run. For example, like earlier we thought, installing new capital equipment and all is not going to be easy in the short run. So that can be considered as fixed. But now in the long run, is it also fixed? No, not necessarily, because you will be able to install new machines and capital equipments. There is no problem because the time is available. That is why it is a long run. And Just it is not going to increase the variable factors of production like it does in the short run. Here in the long run, it will have the capacity, or it will have the capability to change all the factors of production, because all are variable in the long run. In the long run, none of the factors of production is fixed or constant. That has to be understood. So once again, to sum it up, what can be considered as a long run production function? That is the maximum quantity of a good or service that can be produced by a set of inputs. Yes, assuming that the firm is free to vary the amount of all the inputs being used. It is possible for the firm to increase or decrease or vary the amount of all the inputs that it is going to use. If that is the case, then we call that as long run production function. And the theory that we study in order to understand the behavior of production in the long run, that name of the theory is called as the law of returns to scale. So now we have two theories here, production theories. One is the law of variable proportions, which is related to short run. Second one is the law of returns to scale, which is related to the long run. And in the short run, all factors can be changed, but at least one factor should be constant. So what if more than one factor is constant? If at least one factor constant, it becomes short run. More than one factor becomes constant, also it is short run only, right? So if at least one factor is constant, then it is short run. If all factors are not constant, all factors are variable, anything can be varied. If that is the situation for any time period, that time period what we call in economics as long run. And for the long run production function study, the theory that we study is called as law of returns to scale. And for the short run production function, the theory that we study is called as the law of variable proportions. That's it. That is the summary of what is a production function and understanding of the relationship between the inputs and outputs. Though we are not establishing any relationship, but at least we know that there is a strong relationship between the inputs and outputs. Inputs are all independent variables and the output is dependent on the inputs. And the production function can be studied both in the way of short-run production function as well as long-run production function. That's it. That is the introduction to the theory of production, one way we can say. Now there is one small topic here which is not so required actually, but it is there and questions can be asked, so we cannot ignore that. So what is this production function as defined by Cobb Douglas? So there are two different people. Cobb is one guy and Douglas is another guy, put together, working together. Those people have studied the American manufacturing industries, and as I said, that itself is a huge task. They did all this and they tried to come out with some kind of production function where the output, that is the production, is expressed as a function of inputs, majorly taking two inputs. One is labor and the other one is capital. Of course, the general production function what they have proposed is this. You have to remember this formula. In the exam questions it will be asked, and of course the other denotions will be given. You have to substitute and get the answer. That is our job. So what is Q? The output, which is the dependent variable, is equal to K is a constant, not capital. L is labor to the power of A is also a constant. C to the power of 1 minus A. So if for example A is 5, C, A is let us say point, so it's like a percentage you can say. Let us say A is 0.5, C is also 0.5. That means 50-50 they have influence on output. Let us say if A is 0.2, just for example, then that means 20%. 0.2 is nothing but 20%. Then 1 minus A will be 0.8. That means 80%. Capital will have influence. So capital and labor will have influence on Q, that we know. How they will have influence? That depends upon two constants here. One is K, one is A. How much is K, how much is A? That will be given in the question. Once again, we are not the ones to establish that. But what we should know here is the relationship between Q and L and C. So Q is the output, L and C are inputs. How the Cobb-Douglas have defined their production function as is Q is equal to K multiplied with L to the power of A multiplied with C to the power of 1 minus A. And once again, what is Q? That is output. What is L? That is labor. What is C? That is capital. And what is K and A? These two are positive constants. Those are constants. So that's what the production function they have come out with. But their survey or research showed that labor contributed around 3/4 and capital contributed around 1/4 of the increasing the manufacturing production. Once again, is it relevant now? We cannot tell that. What technology was existing when they did the study, what technology we are using now, there is no comparison at all. So this production function, what Cobb-Douglas did, is their understanding of how influential labor will be and how influential capital will be according to them, not according to us, not according to reality. According to them, according to their study, they have proved and they have found out in their research that labor contributes to the 3/4 of the growth, capital contributes about 1/4 of the growth in the manufacturing of production. That's it. That is Cobb-Douglas production function. Of course, it is basically an approximation. We cannot say that it is going to hold good in all circumstances. And practically speaking, if somebody says Q is equal to KL to the power of A, C to the power of 1 minus A, very good, easy to say that. But who will give us K? Who will give us A? That is the biggest question mark. That is not possible and practical to be obtaining them. Still, we don't have to worry because we are not going to do any research. For us, the good news is K will be given in the question. L and A and C will be given in the question. At the maximum, you just have to find out Q by substituting them in the formula. That is, Q is equal to K L to the power of A, C to the power of 1 minus A. That's it. So there are many things which are there in any formula. So let us understand any formula, not only this, wherever, whenever you encounter any formula, always there will be certain number of things for which the data has to be given. For example, here, if at all we have to find out Q, definitely the question should tell us how much is K, the question should tell us how much is L, the question should tell us how much is C, and the question should also tell us how much is A. Then only we can substitute. Otherwise, it is not possible to find out Q. Because we are not going out and researching. Question only has to tell us. Who will tell us otherwise? So if these four are given, what we can find out is Q. So what if Q is already given? Then A is already given, L is already given, C is already given. If at all we are asked to find out K, just for imagination. Yes, quite possible. That also we can do. There are totally 5 denotions. K, Q, L, C, A. Out of those 5, any 4 can be given and the 5th one can be asked. That's what a formula means. Always, whether it is economics, mathematics, statistics, financial management, whatever the name of the subject it is, any formula is basically an equation. There is a left hand side, there is a right hand side. And if any formula has certain denotions, n number of denotions, data will be given in the question related to n minus 1 number of denotions, and you have to find out that missing number, missing figure. So in this case, there are 5 denotions, Q, K, L, C, A. In that, any 4 can be given and you will be asked the 5th. Possibly, yes. But once again, since you do not have the facility of using scientific calculators and all, it is not going to be practical to find out A if other things are given. So that possibility can be almost ruled out. So A should be definitely given in the question. It will be and it has to be given in the question. K, L, C, Q, out of these 4, any 3 can be given and other can be asked. So which will be given, which will be asked, that depends upon the question. But what you should definitely remember is this equation. This is the formula. And according to the information given in the question, you have to substitute it and get the answer for the unknown number. That we should find out. That is what is answer. That is what is solving. And that's what we are supposed to do. If a question is asked on Cobb-Douglas production function, remember the formula Q is equal to K multiplied with L to the power of A multiplied with C to the power of 1 minus A. That's it. That is one sideline small point, and 1 bit can be expected, and 1 bit 1 mark is not cheap. So be careful, remember that. Now coming to the actual discussion on the theory of the law of variable proportions, or sometimes we can even call it the law of diminishing returns. Diminishing returns, this is not utility. Utility was something which was discussed earlier from a consumer point of view. Here the discussion of production is happening from whose point of view? It is from the producer's point of view, manufacturer's point of view, seller's point of view. So names have to be very clearly remembered and understood also, because these are not just vague names. These are particular theories, technically, which have been at least proven or proposed long back, and which are part of the microeconomics since decades. And we are just learning those theories for our understanding of microeconomics as a part of understanding business economics. So now here, the law of variable proportions or the law of diminishing returns. What is the first and foremost important point to note? Is this law applicable to short run or long run? Absolutely short run. The law of variable proportions is a law or a theory which is applicable only in the short run. And we know what is a short run already. In the short run, at least one of the variables should be constant. So that is definitely there. But here, when we observe the law of variable proportions, we will study one variable input with all the other variables held as constant. Though in the long run, in the short run, at least one should be constant. But here, we have to assume all the other are constant, output and input. So let us just take for understanding purposes. Let us say we are studying the relationship between certain things. Okay, so how there is a change in the input, this is input, is going to have an impact on output. So can we study all the factors of input in one graph? Yes, we can. Technology is there for that. But are we equipped with that? No. So what we do, only we study just one factor of input at a time and its impact on the output. How is it going to impact on the output? Keeping all the other factors as constant. So that is a point to be noted here. Why others have to be held as constant? Because we are going to study only one factor at a time, and impact of that one factor on the output is what this theory is going to study, not all factors at the same time. No. Can't that be studied, sir? It can be studied, sir. For that we need 3D technology and all that. And that is not what we are going to do. That is what, once again, PhD in economics, those people are supposed to do that, not CA foundation students. So our job here, our understanding, of course, even they also first have to start with one factor only. So we will stop at one factor. They might increase with many factors according to technology available to them in future. But as far as we are concerned, the theory, the basic theory is concerned also, which is the theory or law of variable proportions. It is going to study one variable input. Example, labor. Is it necessarily labor? Not necessarily. One of the inputs is variable. Let us say labor is one of the inputs. What is the impact of that change in that input on output? So let us stick to one example, that is labor. So if labor is the input, as you keep on increasing the number of units of labor, you have 1 worker, 2 workers, 3 workers. After that, you kept on increasing the number of people who are working in the organization. 100, 200, like that it has increased. As you keep on increasing the input, which is labor in this case, how the output is going to be changing? How the output is related to this input? How the output is going to be impacted due to the changes in this input is what we study as law of variable proportions. And while studying this, all other factors of production are assumed to be constant. They will never be constant. They are assumed to be constant. Okay? There is no other option but to keep all others constant. And because it is short run, it is okay. Because in the short run, the nature of short run itself is that at least one factor of production should be constant. Here, Actually, all factors of production are constant except one variable input. In our example, it is labor. Clear? That is the law of variable proportions. And why we are calling it as law of variable proportions? Because it is telling us the behavior of the output when we change the proportion in which the inputs are combined. How the inputs are combined, the proportion of the input if you are changing, how the output is going to behave, how is it going to change, how is it going to also vary along with the changes in the proportion of inputs is what we are studying. So we call it as law of variable proportions. And this is also called as the law of returns to a variable input. Same thing once again, because one input only is going to be taken as variable and we are going to only observe the change in output which is resulting from additional variable input. So as the variable input is increasing, how the output is changing, how the output is behaving, that is what this law of variable proportions tells us. So can we call this as a law of returns to a variable input? Yes, that is also the name. Or sometimes we can even call it as the law of diminishing returns, because eventually after some period of time the returns will diminish. So we can also call it as the law of diminishing returns. Returns, once again, you should not think from money point of view. Return is what the organization is getting a benefit. In this case, what is the objective? Production, output. So as there is an increase in the proportions of an input, which is a variable input, all other inputs being constant, this variable input is being increased. How is that going to have an impact on the output is what this law of variable proportions will study. So as you keep on increasing the input, how the output will behave is what this law of variable proportions will study. So we can call this as law of returns to a variable input or the law of diminishing returns also, because eventually we will come to know that the returns will diminish. Then what does the law say actually? Now theory wise, what does it say? And we'll also observe it with the graph. In fact, understanding this law of variable proportions is the easiest with the graph than just going through the theory. But still, let us understand the concept first, then we can apply this easily in the graphical representation of this theory. What this law states, as we increase the quantity of one input, which is of course combined with other fixed inputs, keep this in also in mind, because one input only variable, all other inputs are fixed. Along with all those fixed inputs, one input quantity is kept on increasing. We have been increasing. That's what is happening on the x-axis. Then what is going to be the resultant of that? The marginal physical productivity of the variable input must eventually decline. That's what the law says. Marginal physical productivity of the variable input will decline. What is marginal? Same, 1 plus. So as we increase one input, additional, let us say additional 1 unit of labor, one more laborer is appointed. What is the additional production that is generated by this labor? That is what is marginal physical productivity of that variable input. So the recruitment of one additional labor will generate in some additional production, definitely yes. That additional production will not be same or increase eventually over a period of time. When you keep on increasing the number of inputs, the marginal or additional productivity that is generated by the additional units of inputs is going to decline, that is going to diminish. More or less logically speaking, it is law of diminishing marginal utility type, but not really the same. Why? Because there we were talking about the consumer, here we are talking about producer. That is first point. Second point, in the case of law of diminishing marginal utility, the diminishing starts right away. Straight away it will start. But here it will not start straight away. The marginal product, the additional output that is generated by employing one additional input will not start from the first input itself, increase itself, start diminishing. No, it will not. For some time it will go up. but eventually it will decline. Over a period of time, later sometime it will decline. That is why there is a difference between the theory of diminishing marginal utility and the law of diminishing returns. Okay, core difference is from whose point of view we are telling, but the logic, underlying logic is same. Marginal concept is same. There we talked about the marginal utility. Here we talk about marginal product. That's all. But what is marginal? That is the additional thing that is generated by employing one more dash. Here what is that one more dash? That is one of the variable inputs. In this case, our example, that is labor. So by employing one more additional labor, how much additional production can be generated? That additional production is what is called as marginal product. Like this, one more labor is employed, some more additional product, some more additional output is generated. One more labor is employed, some more additional output is generated. But what are these additional outputs that are going to be generated by employing one more labor? That additional output or the additional product or the marginal product, that is going to diminish over a period of time, or after increasing it one by one, when the inputs are increasing, marginal product or marginal output that is derived because of the increase of these inputs is going to decline, is what this theory of or law of variable proportions tells us, right? In other words, simply speaking, an increase in some inputs relative to the other fixed inputs, of course, will, in a given state of technology, of course, technology is always assumed to be constant, cause the output to increase, yes. But after a point, an extra output resulting from the same addition of extra input becomes lesser and lesser. So as you keep on increasing the input, which is a variable input, all other inputs are fixed. Other than this, state of technology is fixed. And when you are increasing one variable input, let us say labor, then definitely it will cause output to increase, no doubt. But the extra output resulting from the same addition of extra input, that is what is marginal. Extra output resulting from addition of extra input means what? That is the concept of marginal. So the marginal output, let us call it, marginal product, let us call it, will become lesser and lesser. That becomes lesser means it is diminishing. That is why we can call it as the law of diminishing returns. Diminishing returns. That's what is law of variable proportions also, because the proportions of the input are changing. How many inputs are changing? Only one. Impact is on what? That is one. That is output. Okay. For this concept to be understood, we should understand three words. One is total product, average product, and marginal product. So these three concepts are important not only now, even later also when we study the theory of cost. Just like when you understand the theory of demand in a very thorough manner, it becomes easier to understand the theory of supply. And when you know already how to calculate elasticity of demand and all, it is not very difficult to calculate elasticity of supply. Those are related, at least conceptually, though opposite but conceptually related. Same way, if we understand production function properly, then understanding the cost function will also become easier. So that is why understanding these words, what is short run, what is long run, law of variable proportions applies when, that applies to short run. And while this happens, what is going to happen? While this law of variable proportions is applicable, the marginal returns are going to be diminished after a particular point of time. So in order to study this, we need to know the three different words and what do they mean. Same words, we will use them for cost also and later for revenue also. So please be very careful in understanding these terms. This is the core technical issue of the entire subject of economics. Total, average, marginal. Simple. These are the three things. What is total? Total is total. That is the sum total of the entire output resulting from the efforts of all the factors of production put together or combined at any point of time. That is total output. Total output we call here as total product. Let us use the same word, total product. But basically what does it mean? It is total output. Okay. But what is happening here? Here all but one factor is constant. all, but one factor is constant. Why one factor is not constant? Because that is the one we are studying on the x-axis. So all other factors are assumed to be constant. Already we know that. And when there is an increase or a decrease in the quantity used in the variable factor, will there be impact on the total product or not? Answer is definitely yes. When you keep on increasing the labor, let us say the same example, whether the output will increase or not? Definitely yes. But how it will increase, how it will change? Is it going to increase forever or how is it going to change? That is what we have to observe on the graph, where we can understand the impact of the increase in the input on the total product. How is it changing? Okay. So that is what total product is all about. Let us understand this with the help of the schedule first, then we can move on to the graph. Let us say the quantity of labor. This 1, 2, 3, 4 is just column numbers. Don't worry about them. That is just nothing. This is only column numbers. Okay. Sometimes every number is confusing. Unnecessary, but it is there. So don't worry about that 1, 2, 3, 4. Forget about them. Then, starting from first unit of labor, one labor appointed, total product was 100. Which hundreds are 100 kilos, 100 liters, 100 meters, whatever it could be, whatever the production they are doing, that is what it is. 100 units, that's all. That units could be expressed in any form, depending upon what the production is. Is it 100 idlis, 100 dosas, anything it could be, we don't know. But when one labor was working, the output, the product was 100. When one more laborer is appointed, 2 laborers are working now, the total product was 210. Same way when 3 laborers are applied, means inputted, all put together, 3 people are working together, then the total product increases to 330. 4 people started working, total product increased to 440. 5 people started working, total product further increased, further increased, further increased, further increased, increased. Now see, stagnated. After the 9th laborer is already inputted, after 9th laborer is already inputted, the total product already reached maximum, that is 750. If 10th laborer is also used, the total product is not going to change at all. It is going to remain same. So what is the use of paying for the 10th laborer? Useless. Because the 10th laborer is not generating any additional output. So not that individually you can match. A 5th laborer only is actually doing the work, first laborer is only doing the work. We cannot match with the person to person here. We are understanding at a conceptual level. Units of labor, that's all. Whatever the quantity of labor that could be, that is units, that's all. People, we can say. So when 10th laborer is employed, there is no additional output generated. That means the total product remained constant. But when the 11th laborer is employed, the total product started declining. Then onwards it will decline only. There is no additional output that is generated by recruiting additional labor. That is the theory related to the law of variable proportions. Of course, this theory particularly talks about marginal product. But in order to find out marginal product, first we should know to look at total product. So how do we know total product? We will not know. That will be given in the question. We will never know the total product. That is reality, right? How many people of how much of variable input is actually used? How much is the total product as a resultant of that? These two will be given in the question. They have to be given in the question. If we have to find out average product and marginal product. So now understand this average product and marginal product. First one is average product. Average product is nothing but total product divided by the number of units of input. So here average product means the total product divided by the number of units of variable factor. In our case, what example we have taken as variable factor? Labor. So 100 divided by 1, so average product is 100. 210 divided by 2, that is average 105. 330 divided by 3, average is 110. 440 divided by 4, average is 110. 520 divided by 5, average is 104. 600 divided by 6, like that 100. Further 95, 90, 83, 75, 67. So what happened here if you observe average product also? For the first labor anyway it is going to be the same because 100 divided by 1 or whatever divided by 1 is that output only. But from 100 onwards, what happened? Additional labor, when a second unit of labor is also employed, average product increased from 100 to 105. Then it further increased to 110, but there it stagnated at 110. Later on, it started declining only. From there onwards, from the fifth laborer onwards, fourth laborer itself, it did not have any additional average product. Fifth laborer onwards, it has been declining 104, 100, 95, 90, 83. So average product kept on declining afterwards. So what we can observe from this? Total product is also increasing up to certain level, later declining. Average product also increasing up to certain level, later declining. But is it happening at the same place? No. When the total product started declining, when it has reached the maximum, afterwards only it started declining. That is 750. So that is the maximum. Then it started declining from 750 to 740 onwards. Further, the table is irrelevant. Why? Because it will make no sense. When the total product itself is declining, why should you increase the number of labor? But at least we know that there is going to be a decline after a certain level. But is the average product also going at the same way? No. Average product started declining here only. That is when the average product reached 110. Afterwards, it continued to decline only. Now look at the third concept, that is marginal product. The marginal concept we know already. What is the marginal concept? The total product of n units of variable input minus the total product of n minus 1 units of variable input. So for first unit of labor, 100 units of total product is there. Naturally, the marginal product will be 100 only. For the second unit of labor introduced, total product increased from 100 to 210. So what is the marginal product here? That will be 110. That is the marginal product. Same way, from second unit of labor to one more unit of labor, 3 units of labor is now used. That means the total product increased from 210 to 330. So the marginal product increased from 110 to 120. From 330 to 440, marginal product is 110. And there onwards, if you observe once again, the marginal product is always declining. So it has reached a maximum of 120. That was the peak. Later it started declining only. So from initially, first unit of labor gave a marginal product of 100. Second unit of labor gave a marginal product of 110. Third unit of labor gave a marginal product of 120. So third unit, second unit, first unit is different. 1 unit, 2 units, 3 units is different. That is the difference between total and marginal. Always we should know that. So what is the total product of using 4 units of labor? 440. What is the marginal product of using the fourth unit of labor? That is 110. So how to get that? Total product of 4 units minus total product of 3 units of labor. So 440 minus 330, that comes to 110. Like that, any two total products are given, we should be able to find out marginal product and reverse way also. So if you observe here, marginal product has been declining, no doubt, but when it has become 0, here, exactly the place where the total product stopped increasing. Till that time, total product was increasing. After that time, total product stopped increasing. When the total product already reached the maximum, its peak, that is 750, the marginal product was 0. Then, when the total product started declining from 750 to 740 and so on, then the marginal product started turning negative. Marginal product can be negative. Total product can never be negative. You can manufacture 2 fans. You cannot manufacture minus 2 fans. That is impossible. You can manufacture 10 bulbs. Nobody can say today I manufactured minus 5 bulbs. Not possible. Breaking the existing bulbs is not called manufacturing minus 5 bulbs. So, total product definitely has to be a positive number. When that is a positive number, divided by another positive number, will have to be a positive number. So, average product cannot be 0 or negative. Marginal product can be 0 also, negative also. From this what we can identify, when the marginal product is 0, when the total product has already reached its maximum. When the marginal product is negative, when the total product started declining. All these things can be observed from the table itself, that is a product schedule, schedule table, both are same. So that is about 3 types of points, total, average and marginal. Here since we are talking about production, we take product, total product, average product, marginal product. That's what we call. Total product is the reality, we cannot actually find it. But once that is given, along with the quantity of input, which is a variable input, then we should be able to find out average product. That need not be given. How to find out average product? By taking total product divided by the number of units of whatever that variable factor is. In our example, we have taken this as labor, that is in the denominator. Number of units of labor is in the denominator, total product, which is output, is in the numerator. So that is average product. So at any point, let us say 7 units of labor. At that point, what is the average product if it is asked? You should be able to take that 670 divided by 7, and you do that on calculator, then you get it exactly. So 670 divided by 7, that is 95.7 approximately. That is average product, and that is how we have to calculate average. Total divided by number of units of input, that is average. Marginal, we know the concept already. Marginal is the additional output generated by employing one more additional input. Simple. That's what is marginal always. Nothing new here. But here only thing is that concept is applied to the product. So how much change in the total product is going to happen per unit change in the quantity of variable factor, that is input. So what is the addition made to the total production by an additional unit of input? That's what is called as marginal product. That we can say the total product of employing n units of input minus the total product of employing n minus 1 units of input is the marginal product of nth input, not n inputs. Marginal product is always of nth input. So that is the point here to be noted. And in every case in the schedule, you should be able to find out marginal product also. Let us say if the question says what was the marginal product of 5th unit of input of labor, you should take 520 minus 440, that comes to 80, like that. You have to check each of them, then you will understand when you practice how to calculate average product and marginal product. These are very important in the exam, same questions will come. Some table will be given, not necessarily the same table, some numbers will be given, but we should be able to know how to calculate the average product also and how to calculate marginal product also. That is a very important point in the production function, no doubt about it. Fine, these are calculated. There is total product, there is marginal product, there is average product. So what? What is the relationship? For that purpose, we need to study this graph. And once again, I would suggest you draw this with free hand many number of times, not less than 5 times, even if 10 times also, don't worry. You have to be able to draw this graph many number of times, because there will be lot of questions where you will have to draw this just like that. Not necessarily you have to be always worrying about your drawing skills, but definitely have to be worrying about where the things are cutting the other curves. Like this, you should be able to just draw with free hand. And what does each of the curves represent? This actually is the total product curve. This is the average product curve. And this is the marginal product curve. Naturally, if you observe, the marginal product curve is the only one which has cut the x-axis. That means where it has turned negative. Of course, if it is perfectly drawn, exactly there, the total product should also start coming down. So we should be able to draw it for understanding of the relationship between average product, marginal product and total product. But we should be definitely able to interpret it once the graph is given to us. In what way, in what sense, in what stage each of these curves are behaving like what. That has to be observed very well. So let us understand them with the theory, at the same time graphs of how there is a relationship between average product and marginal product is there. So there is average product and there is marginal product, that we know, and how to calculate also we know. But what is the relationship between these two? Of course, both are derived from total product, and we know how it is derived also. Average product is obtained by dividing the total product by the number of units of variable factor. Marginal product is nothing but change in the total product resulting from a unit increase, one unit increase in the quantity of variable factor. But what is the relationship between these two things? That is average product and marginal product. Very, very important aspect. Should be understanding and remembering these things also. One by one, let us see. When the average product rises as a result of increase in the quantity of variable input. See, wherever we are talking about variable input, what does it mean for us? In our example, labor. Only one input is variable, right? Whatever that input that is. So there is an increase in the quantity of variable input, which is naturally shown on the x-axis. What happened? The marginal product is more than the average product. Marginal product is more than average product. When? As long as the average product was rising. So when the average product was on the increase or the rising side, marginal product is more than the average product. Let us check the graph. Is it going to be like that? When can we say the average product is rising? We can say average product is rising here. This is place where average product was rising, because after this point average product started declining. But when the average product is rising up to this point, what is the common point you can observe? Where the marginal product curve is it above average product curve or below average product curve? It is above that. That means what? The marginal product is more than average product. When? As long as the average product is rising. That is the first relationship. So what can we conclude here? As long as the average product is rising, the marginal product is higher than average product. That is the first relationship between marginal product and average product. Then the second point comes. When the average product is maximum, average product when it is maximum, marginal product is equal to average product. In other words, the marginal product curve that cuts the average product curve at its maximum. Marginal product curve cuts the average product curve at its maximum. Each of them is a bit. What does it mean? That means when the average product is already at the maximum, then only the marginal product is equal to average product. Is it so? Yes, let us see. Where the average product is maximum? At the point of S. Is it not the point of intersection of marginal product and average product curves? Yes. So, at that point, that is S, average product is already at its maximum. So, at that point, what can we conclude? At that point, marginal product is equal to average product, and marginal product curve cuts the average product curve from the above, that too, when already the average product curve is at its maximum. Where from the marginal product curve is cutting the average product curve? From the above, because marginal product was already higher than average product curve. Prior to this stage, when average product already reached its peak, reached its maximum, then the marginal product and average product will become equal at that point. And afterwards, what happens? That also can be observed. After that, the direction changes. The marginal product is lesser than average product. Average product is more, marginal product is less. So simply three things can be observed here. If you observe this marginal product, average product carefully, as long as the average product is rising, marginal product is above the average product curve. When the average product is already at the maximum, then the marginal product and average product are equal. When the average product curve starts declining, then marginal product is below the average product curve. That's it. When it is below the curve means it is below the product also. So 3 points in this one shot we can understand. That is the third point also that we are talking about. When the average product falls, when the average product is going down, naturally what happens then? Marginal product is less than average product. So these are the 3 important points of relationship that we should identify and observe in relation to marginal product and average product. Once again, you should be able to visualize them if you don't draw. If not possible, you should be drawing it on paper, then you will understand very easily. As long as the average product is rising, as long as the average product is rising, this is average product. When the average product is rising, what can we say? Marginal product is more than average product. That is first point. Second point, when the average product is at the maximum, when the average product is at peaks. So when there is a peak average product, at that level, average product is equal to marginal product. That is point S in this case. So when the average product is at its maximum, average product is equal to marginal product, and marginal product line cuts the average product curve from the above. That also is a bit. So our marginal product line cutting here, where from? Is it cutting from above or below? It is cutting from above. So that is the second thing. When the average product is at its peak, marginal product is equivalent to average product. So marginal product is equal to average product. So that is the second thing we can think about. Then when the average product is falling down, actually, that is happening in this stage. When the average product is falling down. So when that is happening, marginal product is less than average product. That's all. This is the relationship between marginal product and average product. That can be observed in the graph, and you should be practicing this graph also. Total product line you can have a little bit here and there curvy things, not a problem, don't worry too much about it, but definitely marginal product and average product relationship should be reflected in the graph. So when marginal product is like this, the average product has to be going somewhere like this only. So where marginal product can cut the x-axis, that is okay, but average product cannot cut the x-axis. So this marginal product, let us say this is average product curve. This relationship between these two you should be able to draw with free hand. Practice that, then only it will come. By watching it, by just looking at videos, we cannot get these things clearly. So you need to draw them. You will understand while solving the questions why it is very important to draw them. If we don't draw them, solving questions becomes complicated. I'm not telling it is impossible. If anybody has that much of intelligence to visualize this graph and with a photographic memory, what people call it, if you can exactly reprint this entire graph in your brain and understand exactly how this graph behaves, fantastic. I'll be the happiest person. But a typical average student doesn't have that much capacity. So what the average student's best course of action is practice. So you do this, just draw the graph 5 times, 6 times, 10 times, just like that. With free hand you do that. Then you will understand automatically the relationship. Nobody needs to tell you, you don't have to by heart it. That is the advantage. What is that here? So here, of course, the average curve, average product curve has to be at the maximum when we talk about where it is cutting the marginal product line. So wherever this cuts the marginal product line, the average curve has to be maximum. So that is where you have to little bit be careful while trying it. Then with practice only you will get it. After that it should reduce. After that the average product will reduce. So points here you have to note are these things. First point, when the average product is on the rise, marginal product is more than average product. When average product is at the peak, marginal product and average product are same. When the average product is on the decline, then the marginal product is less than the average product. That's all. These are the 3 points to be noted related to relationship between average product and marginal product. That is a very important aspect related to this law of variable proportions. Now, what we can observe is from the table also we can observe, and from the graph also that we can observe how this relationship between average product and marginal product is demonstrated. More than the table, graph is the best way because it is a visual representation. Exactly we can identify what is happening by looking at the graph. Now, we know this already, where the law of variable proportions is examining the production function with only one factor variable, keeping the all other quantities of factors fixed, again repeated, where the input-output relationship is studied and output is increased by varying the quantity of only one input. That's the same thing that is repeated. And this operates in the short run, that also we know, when all the factors of production cannot be increased or decreased simultaneously. So this is also already discussed. But what are the things that are to be kept in mind for the working of this law? There are certain assumptions naturally. Again, more or less, these are also similar assumptions we discussed earlier about the assumptions of production function. First and foremost thing is the state of technology is assumed to be unchanged. It is constant. It is not going to be changing. But really, is it possible? No. That is why we are calling it assumption. So if at all there is any change in the technology, then the marginal product, average product may have a different tendency. They might even rise instead of falling. So this law will not hold good when the state of technology changes. That is why state of technology is assumed to be constant. And definitely we have to keep some inputs as fixed quantities. So we cannot apply this law where all factors are varied. No. If all factors are varied, we call it as long run, right? When all factors are varied, then we call it as law of returns to scale, not the law of variable proportion. So that is not possible. Definitely we have to keep some inputs where there is no possibility of any changing them. But of course, while studying the theory itself, we are keeping all factors as constant actually, except one variable factor. So definitely this law is applicable only in the short run, but not in the long run. That is also very clear. And this law also does not apply to the cases where some factors has to be used in fixed proportions. That means this much percentage of labor, this much percentage of capital, this much percentage of some other factor of production has to be used. Then only the output will come. If that is the case, then this law will not hold good. Why? Because while studying this law, we are talking about increase in only one factor. Only one factor we are changing. That may not lead into the increase in output because other factors are not changing according to this, because we are keeping all other factors as fixed. So naturally, even though we increase one factor, the marginal product of that one factor can be zero. It may not change at all. It may not diminish. Why? Since only one factor cannot have the output to be changing. Since that is a kind of production where the inputs are supposed to be used in fixed proportions. All ifs and buts. If in those cases where the factors have to be used in fixed proportions, this law will not apply, since we are changing only one variable input and we are keeping all the other inputs as constant. But unfortunately, without all the things also going to be changed in the same proportion, the output is not going to increase, because that is the nature of that production. If that is the case, this law does not apply. It's an assumption once again, because all the factors cannot be changed here. Only one factor is changed at a time. But the requirement of that production, according to this situation, is they need a standard mix of all the inputs. When you are changing only one thing, others are not changing, the production will not increase. That means marginal product will be zero, if that is the case. And here another important assumption or limitation we can say, it's not actually assumption. We are talking about physical inputs and outputs. Are we talking about money at all? In this chapter, no. In this unit, no. When we talk about production function, we are talking about physical units of input and output, not economic profitability. We are not talking about monetary terms. We are only talking about quantities of input and quantities of output. That's it. That is the law of variable proportions, how the behavior of total product average product and marginal product can be depicted in one graph is shown in this figure number 1. Once again, you have to be very, very thorough with this graph, preferably by practicing yourselves and developing the ability of drawing it yourselves. And what is there on the x-axis, as we already discussed? That is the input, whatever that input may be. In our example, this could be labor. Any variable factor is on the x-axis. Y-axis is about output. How the change in this input is having an impact on the output is studied in this graph. So how is it changing? Now observe that. Those things which we already have observed earlier in the production schedule, where there is a table, we observed that. What we observed that, we can even observe that in the graph also. Total product has increased up to 750, then only it started declining. And when the total product has reached its peak and when it started declining, the marginal product became negative. Like this. These are all things which we could observe in this product schedule. But we can observe the same things in the graph also, which is more beneficial. Schedule is not something I would suggest you to remember or follow. That is the numbers what anybody can change. But graph is theory. This is the ultimate theory what is proposed. So graph will be like this only. Law of variable proportion graph will be like this only always. It has to be. That is what the theory was proposing. So now the point is here, there are various things that we are talking about. So this is the total product curve where it has reached the peak. That is point H. And as we already observed in the production schedule, what happened at that stage? What is the straight impact of that? Where the total product started declining, where the total product started declining after reaching the peak point of H. Marginal product has become 0 at point M, and further when the total product started declining, marginal product became negative. That can be definitely observed from this. That is the same thing that we observed in the table also. So after this stage, means after reaching H stage, where the total product is declining, marginal product has turned negative. This stage is what we can call as third stage or stage 3. That's what the law of variable proportions will tell us. There are 3 stages. And what is stage 3? Where total product is at its maximum and it started declining. Already total product is declining, marginal product is 0, and then it started going negative. After that, it is all stage 3. At the beginning of stage 3, total product is at its maximum and marginal product is 0. There we are not considering average product at all. Now, stage 2. What is stage 2? Here, stage 2 starts at a point where the average product is at its maximum, that is S. This is the point where the average product is at its maximum, or we can even say marginal product and average product are equal. Both have become equal, where the average product is at its peaks. That is when the stage 2 starts or stage 1 ends. And this phase, stage 2, what is the feature of this stage 2? That we already know. After the point S, what is happening? The marginal product is also going down. Average product is also going down, no doubt. However, marginal product is less than the average product. In this stage, marginal product is less than the average product. That is the importance of or characteristic of stage 2. Now what is stage 1? Stage 1, of course, everything, when we start production, you have to start from 0 only. So right from 0, total production started increasing. Even after stage 1 also, total product will increase. Where it will reach peak? That is at point H. Later it will reach. So stage 2 also production will keep on increasing. Stage 1 also production keeps on increasing. That is total product. But what is the point in stage 1? Here, marginal product is more than average product. That is the feature of stage 1. Marginal product is more than average product. And another important feature in this is average product is on the rise. Average product is on the rise in stage 1. Stage 2, average product is on the decline and marginal product is less than average product. And what is this point S? That is where exactly where the average product is at the peaks and marginal product is equal to average product. So that is the end of stage 1 you can call it, beginning of stage 2 you can call it. Both are same. End of stage 2 happens when where the total product reached its maximum, marginal product became 0. And beginning of stage also starts at the same time, but in the stage 3 what happens? The total product starts declining, marginal product turns negative. These are the 3 stages we can say and observe from this particular graph. Okay, that is the theory of production, the law of variable proportions we can say. And there is one more point here that is called the point of inflection. Where that has occurred, if you observe in the graph, that has occurred here when the marginal product started declining. Till that time marginal product was increasing. Of course average product is also still increasing. Even after some time also average product will keep on increasing. Though the marginal product started declining, average product still increases. When average product starts declining, when the marginal product is equal to average product, then it starts declining. Till that time average product is still on the rise, but marginal product already started declining even before the average product. But when the marginal product is at its peaks, at the maximum, that is what is called as the point of inflection in the total product curve. What is that point of inflection? What is the relevance of that? It is only telling us, sir, till that time the total product is increasing, but it increasing very fast. Later also it is increasing, but it is increasing little slow, like that. It is increasing, but after the point of inflection, the total product is increasing at a slower pace, at a slower rate. That point is called as the point of inflection. And what is the corresponding point to that? If you observe, if you draw a straight line here, that is where the marginal product is at its peak, and after the marginal product started declining, still total production increases, but at a slower rate, at a lower growth rate. From which point onwards this tendency is coming, that is called point of inflection. That is a separate point. But what we should remember is stage 1, stage 2, stage 3. What happens in stage 1, what happens in stage 2, what happens in stage 3. We should observe that very clearly. And that's what is given here also. What are these 3 different stages? The stage 1, the stage of increasing returns. Increasing returns is what this stage is called as. So what happens here in this stage? In this stage, the total product increases at an increasing rate up to a point. In our example, up to the point of inflection, that what we called as point F. Up to that point, the total production increases with an increasing rate. Afterwards also it will increase, but not at an increasing rate, at a decreasing rate, little bit lesser rate. But that is total product. But what we are bothered about is not total product only. We are talking about the marginal product. Marginal product also rises, and its maximum at this point corresponding to the point of inflection, and average product goes on rising. Everything is observed in one graph. What is happening in stage 1? Total product is increasing up to point of inflection at an increasing rate, at which point already the marginal product is at its peak, but average product is still rising in stage 1, though the marginal product started declining. After the point of inflection, still average product is increasing, and still marginal product is more than average product. So that is a point to be noted. And when the stage 1 ends, it ends when the average product curve reaches its highest point. In our graph it is S. That is where stage 1 ends. Average product reached its highest point S. Or we can even say where the marginal product is equal to average product. At that point, stage 1 ends. That is what stage 1 is about. So what happens in this stage? Of course, in this stage, if you look at the curves, average product curve is rising throughout this stage. Yes, because at the end of this stage only it is going to reach the peak. But whereas marginal product curve first rises and then starts falling after reaching its maximum at the inflection point. But the point again to be noted, very important here, is the marginal product, though it starts declining, it remains greater than average product throughout this stage, so that the average product continues to rise. Average product continues to rise throughout this stage. Marginal product, though started declining, still it is higher than average product. Each of them is a bit. And where this happens is the point of, or the stage 1, or the stage of increasing returns, we can say. So why this happens? Law of increasing returns, why it happens? But basically this is only at the beginning stage of any organization, when you are starting with a few number of units of input. As you keep on increasing them, they will be adding better productivity in the initial stages. So to sum it up, in this stage, at the beginning when the organization is new and freshly started, when there are lot of fixed factors which are abundantly available, and when more and more variable factors are added, automatically the fixed factors are also, which are also there, going to be more intensively and more effectively going to be used. So the point is, the efficiency of fixed factors increases as and when the additional units of the variable factors are added to them. And as we know, only one of the factors is considered as variable factor on the x-axis. There will be so many other fixed factors which are also working along with them. But in this stage, those fixed factors and all will work more efficiently and more effectively, more intensively. With every additional increase in the variable factor, the productivity, efficiency of the fixed factors will become more and more. So what happens? The production will increase at a rapid rate. That is what we are talking about. So this is once again a fictional example, fictional stage that we have to keep in mind. But is it generally observed or not, even in an organization freshly started? Definitely yes. Initially, when already there is a machine with, let us say for example, 4 persons are operating that machine, and if you are operating that machine with one more person, then definitely the effectiveness of the machine will be more. Or even you can use that machine for longer hours now. So the fixed factor is there, which is unutilized in the beginning days. And as you are increasing the variable factor, automatically the usefulness of that fixed factor will become more. So just for understanding purposes, rather than taking this completely hypothetical example, let us say a machine is there which has the capacity to be used for 24 hours. But we have only one person operating that machine for 8 hours. So productivity will be only that much for 8 hours. If you can recruit one more person to work in second shift, thinking that it is all possible. Variable factor is labor here. So now instead of working for 8 hours, you can work for 16 hours. The output is more. Imagine if you can add one more person for third shift, then you can work for, say, 24 hours, 24/7 that machine can be used. Machine was available, people were not available, so the machine was not fully utilized effectively earlier. Now, when there is an additional variable factor like labor being added, that is going to increase the output of the machine also. That is what happens when in the first stage, an increase in the variable factors will result in an increasing return overall. That is, in the total product also there will be an increasing return. Average product will keep on increasing in this stage 1, and marginal product, of course, it will increase in the beginning days, and later after some time it will decline. So in this stage, is there a possibility of marginal product already declining also? Yes, but that happens at the latter end of this stage 1. Initially all the three will keep on rising, and they will rise rapidly in the beginning till the point of inflection where the marginal product peaks. That's what is stage 1 all about, and I think that is generally enough to understand the theory of, or the stage of increasing returns. When we think about further and further items of why it happens, what are the reasons behind the increasing returns that happen, more we dig into that, and that is unnecessarily going to be disturbing the original theory itself. So the purpose of this theory mostly is to understand what happens during this stage, during that stage, during another stage. Why it happens? Practically there will be hundreds of reasons. And by just studying one paragraph given in this book does not mean these are the only reasons because of which the increasing returns will happen. Yes, just for general understanding we should know. In the initial stages, the fixed factors which were originally not fully utilized become more and more efficient because of increase in variable factors. That's enough. And that will result in better utilization of fixed factors. So that will result in better output also, which is resulted in total product increasing at a faster rate in this phase. Okay, so that is what happens in the case of first stage, that is the stage of increasing returns, we can say. And not only the fixed factors, the efficiency of the variable factors also will be more in this phase. That also happens. Usually why is that? Because of the division of labor and specialization, various people can share the work and they will do their own bit of work. That also will increase the efficiency of variable factors. So point is, in this stage, because of introduction of additional units of variable factor, the efficiency of fixed factors is also increasing. The efficiency of other variable factors is also increasing. Both are increasing. Naturally, that is all resulting in higher productivity. Right? That is stage 1. The stage of increasing returns. Then stage 2. That is the stage of diminishing returns. Diminishing returns. Naturally, after reaching this point S, that is where the average product was already peak, and from there onwards the average product starts declining, and from there onwards marginal product is below average product. That is the starting point of stage 2, and that is the phase where we can call it as diminishing returns phase. So when will the stage 2 start? Stage 2 will start where the average product is already at the peak. And where it will end? It will end where the total product has reached its peak. Till the total product reached its peak, the total product still keeps on increasing, but at a diminishing rate. Earlier, in stage 1, the total product was increasing at an increasing rate. Now the total product is continuing to increase at a diminishing rate till it reaches the maximum point at H. And once the H is reached, that means that is the end of stage 2. Okay. In this stage, stage 2, what happens? Both of them we observed in the graph already. Both marginal product and average product of the variable factor are diminishing, but still both are positive. Both are positive in this stage 2. And also we also know the average product of the variable input is higher than the marginal product. Our marginal product is less than the average product when variable factors of inputs are introduced in this stage of diminishing returns. So that is the stage of diminishing returns, we can say. And at the end of this stage, at the end of this stage 2, the marginal product of the variable factor becomes 0 and total product becomes maximum, that is H. Both of them can be observed here. M is the point where marginal product is 0. H is the point where total product is maximum. That is the end of stage 2. So we should be able to identify the beginning point and ending point of each of the stages. That is the ending point and beginning point of stage 2. So that is the stage of diminishing returns. Why we call it diminishing returns? Why? Because both are diminishing, which both average product also, marginal product also, both are continuously falling in this stage. So we call this a stage of diminishing returns. Right? Actually, most of the firms will perform and produce and they will be staying in this stage only. So that is why this stage is very, very important. The law of diminishing returns is almost dependent on this stage of diminishing returns. Increasing returns happen only just in the beginning, that they are not going to be sustainable for a long time. Once the average product is already at its peak, the stage 2 starts and marginal product becomes lesser than average product, and both average product and marginal product start declining, And that is where the firms will operate. That is in stage 2. So how this happens? Same things. These are once again vague explanations. Not that really 100% they will work like that in reality. They will happen. The diminishing returns will happen in stage 2 is what we should know. Once again, why it happens? Now earlier we only said that they will have a lot of efficiency, lot of effectiveness, lot of intensity, great work they will do. Now we will only be told that no, they will not do great work. They would have started already spoiling the work. So many people, too many cooks spoil the dish. So automatically the overall output also becomes lesser and lesser. So efficiency reduces, productivity reduces, and already the fixed factor is fully utilized. There is no further possibility of using that fixed factors. So because of all these reasons, in the stage 2, the diminishing returns will appear. Okay. Simply speaking, the additional factors which are added, which are variable factors we are talking about, are not generating any additional benefit. They are not generating any additional benefit. Same in the earlier example, like when we say, our example, we took 3 shifts and all. 1 person was enough. What if you took 2 persons each shift? That machine requires only 1 person. If you had 2 persons on that, not required, unnecessary. Like that, if a machine is enough to be handled with 4 people, when there is a 5th person also is there, what is the additional productivity that the 5th person will generate? Nothing. Already 4 people are enough for that machine. So when an additional input of variable factor happens, rather than adding it to the additional output, the additional output will not be more, it will be less. So the marginal product will be less. Even average product also becomes less in this case of stage 2, where the diminishing returns will appear. Okay, so that is one of the points here. And of course, one of the aspects also is the indivisibility of fixed factor. The machine is there means machine you cannot break it into 2 pieces and give it to 2 people. That is indivisible. If 1 person has to work on that machine, 1 person has to be working on that machine fully. You cannot work half on that machine. You cannot have a half of that machine also. So the fixed factors generally are indivisible. That will always be there. But in the first stage, the fixed factors are better utilized. Whereas in the second stage, the fixed factors are not so utilized. That is a point here to be noted. When there is a more and more variable factors included, increased, then the fixed factors will not work that productively as they did work in the first stage. So that is the point to be noted. In the second stage, the law of diminishing returns will apply. Okay, so that is the point of stage 2. Then the stage 3 is about the stage of negative returns. Negative returns. Once again, always you keep the graph in mind. Negative returns, where they will happen, where the total product started declining, marginal product started becoming negative. That is stage 3. That is called the law of, or the stage of negative returns, where the marginal product of the variable factor became negative during this stage. Once again, why this happens? It works worst and worst. More people are there. No, people are not working. They are playing with each other. Quite possible. So more and more people, beyond the requirement, if people are there unnecessarily, they will not add the productivity. Rather, they will decrease others also. So there is so many sayings are there which can be used for understanding purposes. Practically, again, it is not going to happen exactly like this. Any plant, any production will be somewhere in these stages. If it is a very new plant, it will be in stage 1. Most of the businesses operate in stage 2. Nobody should operate in stage 3, because once you enter stage 3, that means gone. Already that business is better to be shut down, or I would say scaled down, or its number of variable factors should be reduced. People should be fired then. There is no option. That is when the negative returns will happen. More and more people, more and more variable factor, but instead of adding marginal product to the organization, they are adding negative marginal product to the organization. So that means it is a dangerous thing. The total product started declining in spite of increase in the input. That is the negative returns stage. Why is that? Once again same, because the quantity of the variable factor becomes too excessive compared with the fixed factors. Not required. One machine requires one person, two persons you kept. That itself was not good. It was giving diminishing returns. You kept 4 or 5 persons for the same machine. The work will not happen only. All the 5 people will fight with each other or play with each other, or they just time pass. So possibilities are that two excessive variable factors will bring down the returns and they create negative returns. So that is the resultant of stage 3, we can say. But again, rather than why it happens, how it happens in real life, what happens is more important in this particular level what we are studying. What happened and how this has impact on marginal product, average product, total product. That is the entire discussion, and your thought process and your focus should be. That is where it should be. Questions will be on that only. Why it will happen? Maybe those people are all good people. Maybe they will increase also. We don't know that, whether they are good people or bad people, and we are not telling they are bad people also. These are possibilities, and we are taking one example of one variable factor as labor. Not necessarily labor is the only variable factor. There are many other variable factors. They may create negative returns also. When they will start creating, how they will start creating, all these questions will not have any answers, because it is a theory which says any organization will go through these stages. Initially in stage 1, after some time settles down at stage 2. Stage 3 should never come at all. So ideally we should not even think about stage 3, because stage 3 is the worst possible stage, where the marginal product is negative. That cannot be practically imagined also. That should not happen also. So stage 3 is ruled out. No rational producer will produce in stage 3. That is absolutely nonsensical. Why? Because the marginal product is negative. So that is not going to happen. Even in the third stage, no producer will operate. Should not operate, rational producer naturally. Another point is, a rational producer will not also produce in stage 1. Will not stop with stage 1, we can say, because he is not making the best use of fixed factors. Still there is a unutilized capacity of the fixed factors. He can further increase the variable factors so that still the production is increasing. No problem. So stage 1 also, if somebody settles, that is also not a good sign. So here a rational entrepreneur will continue to add more variable factors in stage 1, but where he would continue to operate for a longer period of time or for some time, where they will always produce or they prefer to produce is stage 2. That is the reality. Stage 1 is not the reality. Stage 1 is generally something very, very new organization. For very fresh period of time only it will happen. Usually for any organization they operate at stage 2, and no organization would like to operate at stage 3. That is negative returns. So stage 3 is ruled out. Stage 1 is possible, but that is only for a very short period of time. And stage 1, nobody wants to stop there. They would definitely like to go to stage 2. Why is that? Here in stage 2, the variable factors, whatever they are increasing, in this case definitely the average product that is generated, as there is an increase in the variable input factors, the average product is more than marginal product. That is the beauty of stage 2, where the average product is more than marginal product. That is a stage where entrepreneurs would like to operate and would generally operate. But of course, in this stage also average product, marginal product, both are declining, no doubt. But the point you have to understand is total product is not declining. Total product is still increasing, though at a slower pace. Total product is still increasing. That is why somewhere in the stage 2, where in stage 2, which point in stage 2, that we don't know. That is their choice. At somewhere in stage 2, normally the rational producers will operate or will try to operate. Okay. That is about the law of variable proportions and how this additional factors of input or additional input factors, the variable factors, will have an impact on the total product, marginal product and average product in the short run is what the law of variable proportions will tell us. Law of diminishing returns also we can call it, but law of variable proportions is better to call, because diminishing returns is only one phase, which is where the producers will normally operate. Increasing returns, that phase, stage 1, is not where they will settle down. They will further increase the number of input factors, because there is still possibility of using the other fixed factors of production which are unutilized so far. Then stage 2 comes, where they will try to continue at that stage. Stage 3 should never arrive. If stage 3 is arrived, that is dangerous point for the organization, where the total product is declining with an increase in the inputs. That is absolutely nonsense. Where the marginal product is turning negative, that is also not acceptable to the entrepreneurs. These are 3 different stages. While increasing or changing the proportion of variable inputs, how that increase in the proportion of variable inputs is having an impact on total product, marginal product and average product is the essence of this entire theory. Read it very thoroughly. As I said, draw that graph number of times, that is the only mantra. After that, when the tests are actually conducted, that question I am not getting, this question I am not getting. If you feel, I would say 90% possibility is that you did not draw the graph well, then only you will not get the question. Because if we are clear with the graph, it's very simple. Straight away we can identify. Any question can be answered with that graph, if we are thorough with that. So that is the simple secret. Which we follow, we get the answers easily. Which we don't follow, definitely we are only making complicated for ourselves. So practicing it number of times is easier than leaving it and trying to by heart each stage, stage 1, stage 2, stage 3, this happens, that happens. I'll by heart the entire theory. All that we discussed need not be by hearted at all, if you really have the capacity to draw that graph anytime. Because everything is visible there only, which is more than what, where it is touching 0 marginal product curve, where it is at the same point of time total product is reaching the peak. All things are visible in the graph. Then you don't need to remember them, right? So we can avoid that by becoming thorough with the graph. I suggest all of you practice that graph number of times. Many questions will be asked from that graph. And the concept of this theory of variable proportions, which is a short run approach. And in the next session, we'll discuss about the theory of returns to scale, which is a long-term approach or long-run production theory, we can say. So the short-run production theory, the concept of law of variable proportions, is what we have discussed in this session. In the next session, we'll discuss about the long-run theory of the law of returns to scale. Till then, take care. Bye-bye. Thank you very much.